everybody, welcome back to the Accommodation Show. This week I am joined by Simon Lehmann from AJL Hotelier Group. They do wonderful things in the hospitality space and in the accommodation space and in the tech space and in the short-term rental space. Simon is all over the place. Welcome to the show, Simon.
Thank you so much, and it's super great. I'm super happy to be here today.
Look, I've been really looking forward to catching up with you and doing this particular interview because you're kind of a bit infamous to the industry. There's a lot of people that know who you are and what you do. And what I really like about you is you've got just such a depth of knowledge about the industry, and that's what you do within your consulting business. But I think that today you'll be able to give a lot of value to our audience in terms of the topic that we're going to talk about. Now, before we get into that, I would love you to introduce yourself. Let everybody know who you are, where you're from, and what you get up to in our space.
Sure, absolutely. Let me do that in a short, condensed way. Simon Lehmann, based in Zurich, Switzerland, close to Zurich. We're living out on the countryside, proud father of 5. And I'm a vacation rental enthusiast, if you wish. I've been in the vacation rental industry for 17 years, and I had the pleasure and the honor to serve on some very special companies as a CEO. For 10 years, I was running the largest property management company called Interhome. I was on the board of HomeAway before we sold that to Expedia. I was CEO of Focusrite, one of the largest online travel conferences and research businesses. And since 2018, we're running our own consultancy firm called AJL Atelier. AJL actually stands for the names of our kids. It's Alison, Jack, and Eileen Lehmann. And we founded this business together with my wife, Christina. So Christina and I were running AJL Atelier out of Switzerland. And our team is based in Barcelona. So we have a team of consultants, business development experts, etc., based in Barcelona in our own office. Then we have somebody in New Jersey who works for us, John Ann. And we have more people joining now as we growing along. We as a business, we sort of, in summary, we say we hear the grass grow in vacation rental. That's what we do, right? So that means we're not specifically just doing one thing. We're actually dealing with literally every stakeholder in the industry. So that means from very large private equity firms who are investing into the sector all the way to property management companies of the size of 50 to 100 units. Technology companies in between. So anything that is sort of stuck between the guest and owner in this industry, no matter if they're investors, operators, tech companies, that's who we consult. We help them maneuver in this industry. We help them doing sales, M&A. So we do a lot of mergers and acquisition work as well. So we help companies to be sold. We help companies to buy other companies. And we love vacation rental. I mean, this is what we're enthusiastic about. And we see the vacation rental industry really growing like crazy now. So post-COVID, it's been amazing how STR and vacation rental has benefited from this pandemic, sadly, which is, one way ironic when you look at other travel verticals. But I think we are now really seeing a massive boom, and we have a lot of work to do.
Yeah, absolutely. Look, and what I love about the story that you've just told me now is that you've just got such a huge breadth of experience. You haven't focused on one particular segment. You haven't worked for an OTA for your whole life. You haven't worked in, just the finance side. You've kind of got the whole breadth, the whole gamut of experience. When we talked before we started, you're like, let's talk about guest experience. I'm like, we've got the guest experience covered, and I think that you'll be great for that. But the other side of it is all the technology side, and also the side that I think that gets not talked about enough is the actual building a business to then have some sort of an exit strategy at the end. And I think that there's a huge lack of understanding as to how to build a short-term rental business for it to be viable, for it to be profitable, and for it to have value to an investor to be able to sell it. And then what are these investors actually looking for? And because you've run such a huge property management company, you probably have a huge breadth of experience in that space. And that's kind of what I'm hoping to talk to you about today, and really give some insights to those that are looking to grow into that space. And then at the end, I'd love to cover off some technology conversations, and we can see where we go to from there. So, to kick it off, I would love your thoughts about what, let's say, someone that's already in the short term rental space. They've been in it for a few years, they understand the guest experience side, they've got a good tech stack, they've got a small team, and they're thinking, all right, well, I don't have an exit strategy, I don't have a bigger play strategy. Is that kind of the consulting that you do? And then what would you do with someone like that to help them get to the next stages in their journey?
Absolutely. Yeah, that's what we do. And you just open up a massive topic. I think it's, before you, for the first thing I would like to throw in here in the equation is that that's a personal advice that I can give to companies and individuals out there. Never build a business with an exit strategy in your mind. That's the wrong way to go about it, I believe, because you need to build a business because you have a massive conviction of being successful in a particular industry in what you do. And if you come to vacation rental and see, hey, that's a great opportunity with the technology and the distribution channels you have available, that you can actually build a successful business, that's great. The exit strategy for me is somewhere coming later down the track. But on the other hand, you need to have a plan, because a lot of companies we consult, one of our first questions when you get together is why you're in this industry. And most of the people, the answer is, yeah, well, by mistake, because, I started to manage my own, and then I started to manage my friends and my aunties and my mother's house. And then all of a sudden I had 20. And when you get to 20, it's becoming painful to keep your day job, right? So anything up to 20, you can sort of keep your day job. 20 plus, it's becoming challenges to keep your day job. So you need to make your first decision. Do I keep my day job, or do I continue to be a property management company? And then understanding what this really entails to run and you mentioned it before. I think profitable is a very important aspect that we at AGL talk about all the time, that we need to be mindful that we're running a profitable business that can scale. So 50 units should be less profitable than 100 units, and don't just grow and think it adds value to your business because you grow. I mean, it needs to be profitable growth. And people always say, well, I need to grow. And then the question is, why? Why do you need to grow? Does it help you to add more units? Do you get more profitable with more units? Or actually, you find a good spot at 50 units and you have a good profitability, because as you grow, your costs are going up. And I think very important, before we start talking about exit strategies, you need to understand what the cost drivers of your business are. And I think that's something where we already start. A lot of companies do not know what their operation costs. And as you scale, what happens to all your different cost drivers? To a certain extent, you need an accountant, you maybe need a HR person when you grow above 100 units, whatever. So your costs will exponentially grow. So you need to understand what your cost drivers are.
I need to interrupt you, because I think that topic we need to get a bit deeper on and really give some insights and some value, because there is so many people that I talk to that had exactly that journey that you described of just started, got into it by accident. And nowadays, even there's people that have a similar journey, but they might have gone and learned and been at a conference and got inspired as an opportunity to invest. And then similar sort of journey, but just getting a bit more education before they start. And one of the common things is what you're saying there is that your costs are going to go up, and then you're talking about staffing and, like you said, accounting and legal and all these different things. And quite often when we're building this sort of a business, it's hard to know where to put the money and how to do the math to figure out what the return on that particular investment is going to be and what those stepping stones are going to be. Now, I know that every circumstance is different, but can you help us unpack that, when we should be thinking about increasing our costs and how we measure what output we want from that investment?
Absolutely. To get to the bottom of that very quickly, you need to understand what your cost drivers are. Cost drivers means what incurs cost to you as an operator. And so the first mistake we're making in our industry, we are looking very close to the hotel and the airline industry. So when we look at revenue management, for example, one of the biggest mistakes vacation rental did is we've adopted revenue management practices from airlines, which is totally wrong, and also hotels. Why? Because airlines and hotels have a totally different cost structure. So to start with, and we don't want to do a finance webinar today, but first semester of finance, you have the first two things you need to differentiate when you look at cost is what is fixed cost, what is variable cost. So which costs do recur all the time, regardless how many bookings or how many units you have, and how much costs are actually driven by a booking on a unit level. So a hotel or an airline, let's assume an airline who flies from Melbourne to Sydney, regardless of how many passengers are on board, they have 80% fixed costs. So to fly this plane, the airline has 80% fixed costs. With one passenger or 200, 80% is fixed. So that means they need to have a crew, they need to have fuel, they pay landing fees. So they operate this plane from A to B. 80% of that cost is fixed. So the revenue manager, he's measured by how many packs at what price does he get on this plane to be as profitable as it can be. And you probably have a break-even point at let's assume 60%. You need 60% seats filled on that plane, and then you become profitable. So the revenue manager is looking at seat load factor, and he has different KPIs, key performance indicator, he's measured by to actually fill that plane. And we as an industry have adopted these type of practices. A hotel is the same. A hotel, no matter how many guests are in that place, you have fixed costs. Now in vacation rental, it's totally the opposite. And that's how you need to start thinking about this business. If you have no booking on a house, you have no cost because you pay when the owner when the booking is made. So you have 70% of your cost is already variable because let's assume you have a 30% gross margin in this industry. So that means you rent a place for $1,000 a week and you pay the owner $700 and $300 remains with you. So that's 70% variable cost. And the airline is the opposite, it has probably 70% fixed cost. And so this is the first thing we need to understand. What are my cost drivers? When a booking is triggered, what is triggered? An owner payment is triggered, maintenance, cleaning, bed linen. So these are the things that are being triggered, and these are all variable costs. Why? Because they're associated to a booking. Now, if you have a property management business of, let's assume 50 units, you will have fixed costs, obviously higher than when you have 5 units, because at 5 units, you probably have only your own salary or maybe a software license, which is your fixed cost, because no matter how many bookings you have, that cost recurs every month. But as you grow, you need more staff on site. You probably need 5 cleaners fixed on your payroll, and then these become fixed costs. So you need to start understanding your cost structure into detail, and you need to understand what are my variable costs and what are my fixed costs. And then you start understanding as you add units to it, a unit is potentially becoming more profitable over time, because if you have and then we're going into the next term called unit density. Unit density is something that is extremely important to think about. How many units do you have within a certain vicinity? Let's call it 30 kilometers, 20 miles. We say you can run, if you have 100 units within 20 kilometers circle, then the unit economics will get better and better because you can manage and maintain them with less fixed costs because they are close together. So you can clean more at the same time, you can do maintenance, etc., etc. You have bed linen, you can consolidate or centralize. So unit density is also a very important aspect when looking at scaling the business. And the more density you have, obviously, the more profitable you will become. And you need to look at every unit individually. That's what people tend to forget, that certain units break even earlier than others, depending on its occupancy, depending on the owner contract that you have, etc. So I think the most fundamental piece in vacation rental that you start understanding what are my fixed costs, which are the costs that are always recurring, no matter how many bookings I have and no matter how many units I have, and what are my variable costs based on a unit and on a booking level. If you have that, and if you understand and create that visibility, then I can assure you, you're on the top 5% property management company already in the world.
There you go, folks. There's he's got written it all down for you on how to do it. And look, I'm sure that there's a lot more depth that goes into all of this in terms of figuring out all the maths and all the numbers. But conceptually, I think that's brilliant. You've got those fixed costs and those variable costs. I did want to ask you a question around what you just discussed there, and we don't have to go into this at length, but that to me strikes me as a property management type business model. So where you're a property manager and then you take a cut of 20 to 30% of each booking. How does that work when we're either buying the property or doing the arbitrage model? And the arbitrage model is where we basically lease the place and then we're using it as an Airbnb.
Absolutely. You just raised now the two huge topics, and we could talk about it for hours. Arbitrage is something I would absolutely stay away from. By the way, it's a dangerous business, and we have seen it. So pre-COVID, we looked at the arbitrage business like the Sonder, the Lyrics, and the Stay Alfreds of this world, and they all literally got evaporated because they're built on very weak distribution strategies. So one thing is that you get me going here for a second is make sure when you think about your distribution strategy, you're not building your distribution strategy based on one OTA. That's super dangerous, and I would not do that. So arbitrage, I think arbitrage can be very profitable without a doubt, and it's very tempting. And the good thing about arbitrage, let's say, is you can make very good calculations because you know how much you pay every month for a lease, so you can calculate extremely well, and you can also identify your downside risk very well because you know every month needs to be paid $1,500 for that lease, and that's a fixed cost, right? So talking about cost before, that's a fixed cost, and that just comes back if you like it or not, if you have bookings or not, that cost will come back every single month. And I think arbitrage is really for the pros in this industry, who know the demand dynamics, who know how to build good demand strategies so you have a good occupancy that they can calculate ahead and say, hey, this unit is costing me a year, let's assume $25,000. And my occupancy needs to be at 60-70% in order to break even or make money. So that's the advantage with an arbitrage, that you can do very good cost calculation, but you need to know what you're doing, and you need to be an absolute pro.
Yeah, and I think
now when you own it,
sorry, I was going to say, and I think that with that experience as well. So once you've been doing it for long enough as well, when you're doing those maths and those numbers, you can also see a lot more of the unforeseen things that are going to happen, be it maintenance issues, being regulation, being kicked out of the building, the problems with a particular OTA, all of those particular issues. You'll have that experience. You'll know that you need to build that risk profile into the business in a lot different way than you would if you're a property manager. So yes, that experience, I 100% agree. But I'll let you keep on going.
No, but I think you raised a very good point here. We call that get over the honeymoon period, because on paper, this looks fantastic, right? And then you need to start understanding, what are my risks? What is happening to my business if this particular unit is not going to make a booking for 6 months? Can I still afford it? Really think of the worst. And we have seen that. We are now seeing thousands and thousands of people who are building their business on the back of Airbnb. I think that's not sustainable in any shape or form. But anyway, I don't want to start a controversy here. I'm more than happy to discuss that offline when people want to talk to me about this. But we have seen it. In 2019, I had the pleasure to be together with the STR legends in Cartagena. We had a great outing with some incredible businessmen who have built beautiful businesses, 200-300 units on the back of Airbnb. They were driving big cars. They things were going well for them. And then what happened? Airbnb turned the tap off because they reimbursed the guests and not the hosts when the cancellations were flooding in during the lockdown in 2020. Well, some of these arbitrage guys, they had to fold their business within 2 weeks. I know of a guy in Seattle, he was literally selling furniture off the street to make a few bucks to pay off his master leases that he had no bookings for. So we need to be really mindful. So let's go to the second point, which is the ownership. I mean, I love ownership, right? But here again, there is a risk to it. I mean, at the moment, hardly anywhere in the world you can do anything wrong with real estate. Is that going to continue? We don't know. I think the pandemic has started to help us understand how vulnerable we are to certain things we do not have on our radar. And the pandemic was surely one of them, which was truly global and everywhere, right? And now we have a war. We have a war in Europe that could have massive, tailwind effects to the economy and everything. You know, I said to my wife yesterday, I mean, today we're paying 180 for fuel. It could very well be that in 2 weeks we're going to pay 250 for fuel, and more. And you know, the fact that Russia supplies 60% of gas and oil in Europe is massive. So let's think about this. And this has helped us, or starting to help us, to really understand what are my downside risks and how much do I take. Ownership is great because you can have it, money, but then the danger again is money is cheap. So I can afford this house as a 2% mortgage, right? But what happens if the mortgage goes to 5-10%? Inflation will come. I mean, that is now becoming very clear that this war will have a massive effect on speeding up inflation, and it's going to happen, and if we like it or not. So we need to think about this, and this is the only thing I'm saying. Whatever risk you want to take, ownership, arbitrage, or doing a classical model, you need to understand what are my risks in the worst period and how long can I survive if things do not go well. And then, you know, as long as you can have a good risk profile and adapt to your business practices to that, that's fine. I love ownership, and I think we will see a lot more of that. We're seeing now massive investment funds in the US who are buying hundreds and hundreds of properties. Now, is that the right thing for the community? You know, is that something that regulation that's going to wake up the regulators and say, hey, is this the right way to go about it? But of course, it's becoming predictable because you know how much you pay for a mortgage. You hope that the value of the property appreciates as well. So you actually grow in the assets that you have. But hey, is that bubble going to burst? I mean, we've seen real estate prices in Australia rising for years and years and years and years. Is that continuing to be?
It'll never go down, Simon. Never.
There we go. So we just opened another can of worms there.
Yeah. But so let's get back to where we were at the beginning. So we're talking about sort of scaling our property management business, and we've said that we want to look at our costs. We've got our different business models, which we've kind of covered here, and there's different ways to do things. So we're looking at our costs, and then we're thinking about kind of what that next step is. So what's the wisest next step, Simon?
Absolutely. I think that's choice of technology. Whenever we work with property management companies and we ask them, you know, what are your biggest pain points? It's two things. It's dealing with owners and getting growth, like getting supply. That's a huge pain point for property managers. And the second one is technology. So it's either or being the first one. In most cases, technology is the biggest problem. And I think here again, the biggest mistakes that are being done of not making the right choice of technology. And that can be extremely painful and can be very expensive. So I think doing some more homework before you choose your technology stack is going to be the best, let's say free advice I can give you today. And you're going to like us for it, because we are totally overwhelmed by companies we're seeing in kind of what kind of choices they made over technology. So let's be fair here. First of all, there is no global university where you can learn how to become a property management company. Not yet. We're working on that, right? So, by the way, we have hotel.school/vacation rental. So we offer courses online, how to become a professional property management company. But yeah, there's no university, so you need to learn by everybody else. You can become a hotelier. You have the best hotel schools around the world, but they don't even talk about vacation rental. It's the devil. So we need to learn from each other. And I think we are the classical guy or girl who's going to property management is not really tech savvy. Fair enough. They're hospitable people. They like to deal with individuals. They like the product itself, but technology you need to have, and it needs to run because it will help you further as you grow to create massive efficiencies. So your fixed costs don't actually increase again. So technology choice is extremely important to keep your fixed costs low and have a higher variable component that allows you to grow. The right PMS. Does it cater for your requirements? What are your requirements? Do you want to offer deep service? Do you need good guest communication tools? You need to are you able to upsell additional features like tours and activities or food or whatever? Do you want that or don't you want that? Do you want to build a multi-channel distribution? Have you thought about your direct marketing? Do you want to build a brand, or you want to rely on OTAs only? All that stuff has a direct impact in how you choose your technology. Do you want to have a seamless guest experience, meaning you're working with IoT companies, Internet of Things? Do you want to have seamless check-in, which means you need automated door locks? Do you want noise sensors because you're conscious of noise violation, etc., etc., etc.? And I think that is something you need to think about to start with before you start choosing your technology stack, because a lot of PMs are changing their technology as they evolve and grow, and that is very painful and very costly.
Yeah.
Right.
So on that, so that's and this is one thing that I definitely talk about a fair amount, is understanding what our business is and who we're catering to, and trying as we grow our property portfolio to try to lean into what we know best. And then to cater to that particular market, build it out, understand it. Then afterwards, once we figure that out, we can go and build a secondary market or a secondary set of properties. And what I'm talking about is, are we doing apartments in a city? If we're focusing on that, when we focus on that. If we're doing holiday rentals by the beach, then maybe stick with holiday rentals by the beach. Don't go into the mountains, because all of a sudden you'd think it's the same, but it's dramatically different in terms of the problems that you're facing. Where do you sit in terms of this debate and the kind of the advice that you would give to people in terms of figuring out what they're meant to do?
I shouldn't say great question, but it is a great question. That's just made me smile because, it's so many stories come through my head on conversations that we had. And it's interesting what we have seen. So let's rewind the clock a little bit. 2019, we had a clear demarcation line between urban operators and rental and leisure operators, right? So, hey, they're the STR guys. They sit in the city, and these are the leisure guys. They're in the leisure destinations. And what is the result now post-pandemic is that the urban guys got hammered. So of course they're tempted to do now vacation rental as well and go to the leisure destination, because they need to diversify. They need to again, look at their risk profile and say, hey, if the cities have no demand, I might as well go into leisure destinations to have a little bit of bookings and break that peak, because an urban destination is not seasonal, or is far less seasonal than the leisure business. And they're more used to that. An urban guy sort of deals with 60, 70% occupancy all year through. Well, the leisure guy, he has a season of 5, 6, 7 weeks, and then it drops off again. He has shoulder season, he has peak season, he has secondary seasons. So it's totally different. And it's interesting that the urban guys have diversified their portfolios because they had to, because the cities were affected a lot harder with the pandemic than the leisure destination. Now, if you speak to the leisure guys, they say, oh, hell no, they will ever go urban, because that is not what we do. We're the leisure guys. So I think we see only one thing. So the leisure guys do not go urban. And we see that on the large side. So let's look at Sykes Cottages, for example, the UK's largest property management company, massive, growing like crazy. They have no urban inventory whatsoever. They're leisure guys. Interhome, Interchalet, so the traditional leisure brands, Belvilla, Novasol, all these huge European leisure brands, they have no urban STR portfolio, and they will not going to have that, because it's a different game. You have a different ownership structure. You mostly deal with more institutional owners than you deal with individual owners, etc., etc., etc. So I think there is no recipe, but I think, to go back as a summary, stick to what you're doing well and do that extremely well, because a lot of people say, hey, I need to grow. And then, it's interesting and say, look, in this destination, we've built a fantastic brand. It runs seamless. I want to go to the next city or the next destination. And
This was my next
my
question, Simon. You're pulling it out of my mouth.
And then I was like, why do you want to do that? So my first question is, how big is your total addressable market? That's something we love to talk about. It's the TAM, T-A-M, total addressable market. I said, I have 50 units in this city and then in this destination. And I said, how many, let's say, rentals are there? Well, there's like 700. I said, why on earth do you want to go into a new destination? Because your fixed costs will go through the roof. Just because you're successful in destination A doesn't mean you're going to be successful in destination B, because you're already doubling your workload because you're in destination A. And it's becoming distractive, and it's not that easy to go into destination B, because then half of your time is then already in destination B. You add more cost and more focus. So before you start growing into new destinations, which adds a lot more fixed costs and structural costs to your business, make sure you're the king of destination A. If there is still plenty of addressable market, do that well. You become more profitable than just going into people always. And I have helped so many companies to make that not making that mistake and say, hey, we are sort of the king in that destination. Now we're going to go to next. Why?
On the other hand, I'm really curious about this. I find that because of the pandemic, there's a lot more, and because of the technology that we have that we didn't have 5 years ago, there's a lot more opportunity to move into several different markets at the same time. So let's say we're catering to the same avatar, right? Like it's a romantic couples getaways, or one that I really like is the extreme themed accommodation, right? So you can theme up an accommodation and then you really understand your avatar and your market, and you could potentially open up in different cities. And the technology is actually enabling this to happen a lot more often than maybe it would have done in 5 years ago. I would love you to discuss just from a profitability point of view, because this is what we're talking about, right? It's like, yeah, you can do it, but how does it affect our profitability if we start playing that game? And has technology managed to help to bridge that profitability gap?
Sure. I think you made a very good example, and the example that you've made is a brutally focused example, because you're a specialist in some minor, tiny vertical that you obviously need to grow in different destinations because you don't have that supply grow. I think that opens another point when you talk about doing a property management business. What you need to think about is costs. We talked about your tech stack, and I think the third thing, it actually comes at the beginning. Who are you? What are you trying to do? Do you want to be the Joe Blow of everything, or do you want to really be focused and say, look, we have the best getaways, the best houses? Do you go after absolute quality? Do you go after top guest experience? Who are you? So your elevator pitch to define your business is extremely crucial, because we see property managers who sort of grab any supply they get from 1 star to 5 star. It's a mess, right? But when you describe your business and when you describe your, who are you and what you're all about, you need to be very clear on that. That will help you then to shape your structure, and to shape your strategy and shape your next steps. So if you're as specific as you said, then of course you have to go to certain markets, because a certain supply of theme, let's say a theme provider or a top experience provider is, then you have not that massive addressable market. So you need to grow into several markets at the same time.
So if we're talking about our fixed costs and how they're impacted by moving into multiple locations, what are the main things that we need to look at?
Absolutely. I mean, they will happen. I think that's the most important thing to think about. And they will happen. As you go into more destinations, your fixed costs will increase substantially higher than if you want to scale your operation in your current location where you already have costs, right? So you need to be very mindful of that. And on top of that, and I think that's one thing we always need to remind ourselves, we are in a hyper local, hyper personalized business. Vacation rental is based on trust. Our assets are the relationship we have with homeowners, and this is not going to change. Despite the fact we're now seeing people who want to buy their properties, do master lease arbitrage, so they don't deal with several owners. At large, vacation rental, 90% of global supply will come from individual homeowners. So that means we will not own it. We own a relationship, and that is trust. And building that in one location is one. Can you build the same again in a new location? Maybe not, because you're not the local guy. Not the people don't know you. You don't have the relationships that you have in location A. You don't have that in location B. And that's always something we need to remind ourselves. We're working in a hyper-local, hyper-personalized business. And we need to think about yourself. Am I able to build the same relations in a new destination that I've built in the location that I'm operating in?
Yeah, look, I couldn't agree more with this sort of thing. And I know the business that I work with and property managers taking properties off of each other. And I've seen it being done because the person that took it off of a client, when I work locally, I know everybody, I know exactly what you're dealing with, what pains you have. I can go and check in the people and make sure that they're not going to destroy your home and that sort of thing. So I think you're absolutely right. Now, look, I'm really conscious of the fact that we're getting towards the end of our time together. I like to keep these episodes really concise so people get loads of value and remember, those key points. But the one thing that we haven't touched, but I really would love your insight, is the exit strategy. Hey, how do I build towards something that's going to be of value to a company to take off of my hands and then create a bit of wealth for myself? Are there any fundamentals you can guide us down?
Sure. So one thing I already said, do not build a business to exit, please. It's the wrong motivation, because you will make a lot of mistakes. You can't build something fundamentally that is of value. Think about the exit strategy later. When you're in the business, you think, okay, maybe in 3 or 4 years, have a plan. What do I do in 5 years? Well, I'm actually going to exit this business. Okay. And build a long-term exit strategy. Like a 3-year window is an ideal thing to start thinking about. Hey, I need to make life changes. In 3 years, I want to be out. I want to make money. Okay. So have an exit plan over a certain period of time. Don't do this overnight. It's not going to go well, because the better quality business you sell, the more value you will get. Number one, start depersonalizing your business as quickly as you can. Because if you hold the 100 relations to the homeowners, you will never be able to sell your business. Because when you leave, then everybody will leave and then the business is worthless. So this is the problem, because we're not selling assets in our industry. We're selling contracts that are based on personal relations. So number one, for your exit strategy, start depersonalize your business. Have somebody else creating these relationships to the homeowners so they can be transferred to a new owner. Second, build an exit strategy and maximize your profitability, but don't destroy the business doing that. We see a lot of people who take so much cost out and make a very profitable business when they want to sell it. So they have higher profitability ratios, but at the same time, they're reducing their operating costs so much that it harms their reviews, that it harms the guest experience and everything like that. And so be reasonable. And of course, you want to make your business more profitable maybe when you're running it today, and look, I can probably afford a couple of cost cuts, or I can scale a little bit more. If I add another 20 contracts in the next year, it will help me also to be more profitable. So we're going back to the first topic we've covered. When you build your exit strategy, you need to know what your cost drivers are. What are your variable and fixed cost drivers? And how can I adjust those to make my business even more profitable, more sticky, and depersonalize it? That's the most important. I have seen so many property management businesses that couldn't be sold, or it was really important, because you need to think about the day you exit, you're not going to walk away, because the new owner wants you to stay for at least a year, if not more, to make sure you're reaching that. And that's all the things you need to think about your planning of your exit strategy. Are you exit strategy? Do you want only cash, or are you willing to take some shares from the next owner, or are you willing to stick around for 2 or 3 years with an earn-out scenario, which means you want to have a really aggressive business plan for the coming years, and then the new buyer looks at it and says, well, this is a great business, you're profitable, the next 3 years you want to be more profitable. Hey, I have you hanging around, I give you now 60% of your business, and then the 40% will come when you achieve the business plan. So there's so many different components, and that needs to be planned extremely well. It's not a clear-cut business transaction, because we're selling a business that is based on relations, and our assets are owner contracts, and they're very hard to value, right? So for that reason, you need to be aware of these drivers before you start making these decisions. And in most cases, and this is maybe another advice that you need to think about, in most cases, exits will always take a lot longer than what people plan them to take.
Yeah, and so the other question I have, and because you've got more exposure to this than I do, what size can we start to think about selling our business? Is it 20,
Great
or is it
question.
100, or is it 500? And I know that there's always, it all depends, but surely there's buyers looking for particular things that you're seeing right now.
Absolutely. I think any size, it doesn't matter. It's just what makes economical sense, right? Also for the buyer. You know, small businesses, no matter of the size, the work that you actually have to sell a business is always the same. But, now here comes the big but. The smaller the business is, the more likely it's actually going to be an asset deal and not a share deal. What does that mean? The new buyer will only pay you on the contract that he will take over from you. All right, so that's an asset deal. So that means the buyer takes over your assets, but doesn't take over your business, doesn't take over your legal liabilities, nor your legal entity, doesn't take over your tax burden from the last 5 years, all that stuff. So asset deals are only based, the purchaser buys your assets with your contract. And if you have 20 units, you get paid a fixed amount per contract that is being converted into the new owner. That is not that attractive also for you as a seller. So of course, needless to say, the larger the business is, the better to make more money. And I think size matters also in terms of valuation. You know, if you're below the 100 unit line, then it's most likely it's going to be an asset deal. So the buyer will only pay you by the number of contracts you're going to give him. If it's getting bigger than that, when you have infrastructure, when you have team, when you have resources, when you have a brand in a location, because you want to buy somebody because you want to be in that location, then the buyer is, first of all, prepared to pay a higher number for that business because it will be strategic of higher value than just adding a few contracts in a city it already operates. And that is something you need to be mindful. When you drive value to your business, what are the value drivers really for a future buyer in your exit strategy? And then think about how large is that business going to be, and can it be an equity deal instead of an asset deal? Because ultimately it might be more interesting for you economically to make a share deal.
Look, I was going to finish up the episode, but there's just one thing that's just piqued my curiosity, which I just need the answer for. The brand part of it, being a property management company, quite often, because we are leaned into the OTAs, it doesn't really matter. You know, all our business comes from an OTA. When we talk about building that brand, what do you think has value to an investor?
Yeah, absolutely. The more direct bookings you have, the better. So I hope Matt Landau is listening to this episode today, because we had always a big debate about branding in the past. And I'm just saying, hey, please do not spend your money on Google. That's a waste of time, but spend it in the destination. And building a brand is something you need to make consciously right from the start as well. We talked about what is your key drivers for decision. Who are you? What tech stack do you use? And what am I going to build? And am I building a brand that I want 60% repeat customers? Well, then go about it. But if you say, look, I'm happy to depend my business entirely on OTAs, that's far less valuable. So in an M&A transaction, it's needless to say, and I'm super glad you raised that point. I mean, a business that is entirely based on Airbnb has, for me, literally zero value to buy, because I can do that myself, right? But if I buy a business that has 70% repeat customers over the last 5 years, that is good as gold, because I can sell my other 200 units that I manage to these people as well. So the brand that you have, and the when we look at distribution mix, I mean, if you get your revenue from 20 or 30 different channels, fantastic, because you diversify your distribution strategy, and there is direct business coming off that as well. The more direct business, the more valuable you are. Simple as that.
you can come and work for me, Simon. I need you on my team, because this is the kind of stuff where I think people really miss out on that. And we talk about databases, and it all sounds pretty boring, right? And people don't understand the value of the brand and what it can do. And the really interesting thing is that we're talking about short-term rentals and having a property management business, but even if you're a boutique motel, hotel, any of those categories, you still want to have a super strong brand so that when you do come to sell the property, you've got something that has more value than just an Airbnb listing or an OTA listing. So we're speaking the same language.
Absolutely. I'm glad to hear that. Despite the fact we're in two different continents, we still speak the same language.
There you go. And that's the beauty of this show, is that really we do get guests from all over the world. We had someone from Thailand a few weeks ago talking about social media influencers, and all of those rules applied everywhere in the world. So it's incredible. Look, I'm going to thank you so much for your time. The community thanks you for basically giving us free advice, giving us free knowledge that you spent years learning, and it's incredibly valuable to me and to everybody, so thank you. Is there anything the community can do for you in support of your business and what you get up to?
Yeah, absolutely. I mean, they can follow AJL Atelier and follow me. Send me an email, engage with us. We do a lot of research projects. We can bring a lot of value to the table. My email address is simon.lehmann, Lehmann, at ajlatelier.com, or you'll find us on LinkedIn. Come engage with us, follow us, and we'll definitely hear from each other. I'm looking forward to engage with the audience around the world, and we get these opportunities every now and then. And thank you so much for having us on the show.
Yeah, no, I'm the one who's very grateful. I do have a question. If someone was looking, so obviously there's a university which is coming up, and that will teach people a lot of the fundamentals and really help them. But if someone was looking at a consulting sort of reach out to you and say, hey, I've got a business, I really don't know what to do next. What sort of size are we talking about before that kind of it's reasonable for you to sort of engage with them?
Yeah, absolutely. Great question. I mean, at the end of the day, size doesn't matter. It's just more the conviction. And the beautiful thing about our work is we don't need to force ourselves become a consultant on somebody's business. People come to us because they need help, right? So, and that makes our job far more enjoyable than a classical Boston Consulting or a McKinsey, which normally are driven by board decisions, or a strategy session needs to happen. You know, in our case, it's the opposite. The owner of a property management business is coming to us and says, Simon, I'm at a point where I need help. And I know you can help me do my exit strategy, do my growth strategy, look at my personnel. You know, we've done coaching, we've restructured businesses. We put your tech stack together for you. We help you build a strong team. We help you build a growth strategy. And people come to us because they're convinced that we can add value to them. And they're also aware, like-minded people and professionals, that consulting doesn't come for free. And so we're trying to be very reasonable in our pricing. We have junior and senior consultants that come around to your business. And so the size actually doesn't matter of the property management company. It's something that, an engagement with us, depending if it goes over a certain period of time or how many days it's going to be, I think you need to be willing, bottom line, all in over a certain period of time, you need to be willing to say, hey, this is worth for me, let's say $10,000 over a specific period of time that I'm willing to spend. Of course, you can have it cheaper if it's less days. But I think if you want a bit of retainer, that we're working on 6 months together on a recurring basis, etc., you need to be able and willing to pay, as I said, you need to be willing about $10,000 to put aside to have a consulting mandate that will drive value to your business.
Love it. And I'm so sure that's once they spend the 10, they come back and say, we want more because we've done so well. And I know proof is in the pudding, because there's so many businesses that I've seen grow and do really well that have worked with you. So it's a testament to the work that you're doing. Look, once again, thank you so much for coming on the show. Really do appreciate it. And for those of you that are listening, that are enjoying the content that we're producing, please don't forget to give us a like, subscribe to the channel, and leave us a review. Let us know what you think. Also, if you've got any questions, you can put them in the chat box, and either myself, my team, or Simon will get onto it, and we'll give you some feedback. So thank you once again, Simon. I really do appreciate it.
Thank you, Bart. It's been great.
Thanks.